what has made dual stacking particularly well suited for Bitcoin or a good alternative to look at for Bitcoin staking?
Yeah, so I think there's a few things. I think just taking more of like a 10,000 foot view on staking overall. So we view staking as really the risk-free rate in crypto, or it's the closest thing that you can get to a risk-free rate across all the proof of stake networks that exist. So on ETH, maybe that's 3%. On Solana, maybe that's closer to 8%. Now, we didn't really have anything for Bitcoin where you can earn a very low risk predictable yield in a way that can also bolster, be additive to the broader, maybe DeFi ecosystem, where you could actually leverage your Bitcoin in new and interesting ways. So I think when it comes to dual stacking, now you can make a credible argument that, now there is a way to earn a relatively low risk. I never want to say risk free, but relatively low risk yield, Bitcoin native yield, as Andre put it. I think that's something that we're definitely very interested in and our clients are very interested in. At Chorus One, as I mentioned, we're very institutional focused and we really touch many, corners of the industry. We work with liquid and venture funds, custodians, exchanges, wallets, and it's been interesting to see how over the past 6 to 12 months or so, the types of clients that we've been in constant conversation with has really morphed and changed. It's definitely become more traditional, more TradFi oriented, which is just kind of like I think it's just like a broader wave that's sweeping up the crypto industry overall and where the general direction that crypto is going. So as part of that, we get some of unique insights into what these types of institutional clients are looking for. They're looking for, again, security, predictability, compliance. And overall, I really think that, 2025, this year is almost like a test case for these institutions to start dipping their toes in the water. And that's why I'm very excited about 2026. I think 2026 is going to be prime time, and we're going to see much more institutional involvement and real capital coming into the space.
Andre, I see you shaking your head left and right over there, up and down, I should say, in agreement. I How do you feel about the user base for dual stacking? I mean, we went from, zero Bitcoin being staked or stacked in both liquid or other protocols as well. And suddenly we have almost 70,000 plus at its peak and growing as well. Do you see the same user base? What does that user base look like for you when it comes to dual stacking?
Yeah, I think dual stacking was really made for both retail and institutional participants. I'd say as of right now, there's around 100 million USD worth of value that are participating in the dual stacking program today. And probably around 80% of that is institutional capital, and 20% of it is more retail, long-term Bitcoin holders that are really moving their Bitcoin out of cold storage for the first time in many cases and trying to earn a yield on that Bitcoin. And so, I think we're definitely seeing traction from a lot of crypto native institutions in particular who are looking to be able to monetize the Bitcoin that is sitting on their balance sheet that has been mainly idle. And for retail participants that just haven't had access to high quality Bitcoin yield opportunities in the past. And so this is an easy way for them to participate. And I liked what Lior had mentioned around sort of the risk-free rate. I think that's how we've seen the framing of traditional proof of stake networks. But again, that's something that doesn't exist natively on Bitcoin. So if we can start to provide that on layer two, leveraging some of the unique capabilities of the Stacks network, that's really where we can start to see that growth start to take off.
So let's dive deeper in the term risk. Yesterday on the institutional side of our webinar series, we did talk a lot about operational frameworks and risk frameworks that a lot of institutions are starting to implement, or custodians and miners, and even those of us here at Stacks are starting to help educate and put in process as well. Um, Starting with you, Andre, coming back. Hope you got a breath in. Talk to us a little bit about the core security principles behind dual stacking and how the model helps to preserve self-custody while still enabling yield today or in the near future as well for that risk framework as people are looking to enter this in the first time?
Sure. So dual stacking has been built on sBTC, which is again a one-to-one Bitcoin-backed asset built on the Stacks network, and it's secured by a set of institutional validators that were selected by the Stacks community to secure and maintain the underlying protocol. And so that relies on a 70% quorum of validators to uh, move any Bitcoin in and out of the protocol, and it's been live for a year now. I think today is actually the year anniversary of sBTC, and so I think at that point sBTC is becoming more battle tested, having been on the market now, and so we can really start to see that the protocol start to harden there. In addition to that, we are moving to a model that is self-custodial first. I think that is feedback that we hear often from our users for how do we continue to evolve the protocol to become more trust minimized, as trustless as possible over time. There's a large market of users who want self-custodial yield options, whether it's because that fits their due diligence and risk models that they have internally, or maybe they're just operational procedures that institutions have to follow in terms of who can custody the underlying Bitcoin. So I think self-custody is heavily requested from both retail and institutional. And I think we're excited about some of the work that we have coming out in Q1 to that extent.
Yeah, if I can just
Uh,
jump in here, I just want to underscore that point that Andre made about self-custody. Like that is a huge requirement that we're seeing amongst our client base. And at Chorus One, we are fully non-custodial. Like we obviously run all the node infrastructure across all the networks that we support. But we have had to build close relationships with the leading qualified custodians in the space, because the larger institutions, they're legally mandated to use the QC to actually custody the assets. So, I think self-custody, integrations with qualified custodians is definitely a core piece of this as well.
and Tycho, thank you, Leo. Are you seeing similar? Are you seeing a demand and interest around self-custodial as well from Zest clients or others?
Yeah, absolutely. I mean, having custody over BTC that is deployed, on chain or programmable in some ways, right? So retaining the custody of the underlying BTC, that's really the next frontier, right? That's really what's going to like unlock the next chapter of BTC 5, right, as they say. And yeah, that's mainly because a lot of BTC is, slowly and surely, being held by institutional holders, right? And those institutional holders are often like, under certain mandates or, have bound by certain rules by which, they can't, lose custody over the underlying assets, right? So that's, for example, why a lot of these um, these actors like option strategies, right? Because you can sell options without moving the underlying BTC anywhere, and then to be able to deploy BTC into DeFi or move it on chain to do stuff with it, right? Whether it's borrowing against it, whether it's generating yield while retaining custody of the underlying BTC, that will be huge, right? If you look at how the big institutional players borrow today, they do it usually through these tri-party agreements where they move BTC to a custody account that's separated, and then they borrow against it, right? And a self-custodial programmable BTC that can really make this institutional use case accessible on chain, but then also make it scalable and accessible to retail investors too. So I think it's a very exciting development, and I think my prediction for 2026 is that we're going to see a lot of it, and of course on Stacks too.
Absolutely. And in Tycho, one of the biggest markets, 2.5 million BTC sitting idle in public markets and financial products today. Just under half of that sits in treasury companies DATCOs, digital asset treasuries, many different names. As you start to look at the maturity of that market, which is already a big maturity year to date as well, mind you, how do you see dual stacking maybe fitting alongside when it comes to that additional way to earn yield on your BTC? So we talked a little bit about options. We've talked a little bit about sBTC. Now let's throw staking and stacking into that mix. What does it look like from a participation standpoint in your prediction?
Yeah, absolutely. I mean, this is something I've been thinking about a lot, right? Because next to running Zest protocol and working on stacking DAO and things in the Stacks ecosystem, I'm also running Bitcoin strategy now for a Bitcoin treasury company, for treasury, which holds a bit over 1,000 BTC. And yeah, that's really like the key thing to look out for, right? Like it becomes a lot easier, right, in general for these Bitcoin treasury companies to participate at the moment when they can retain custody over the underlying BTC, because those are the kind of products that are available in an institutional wrapper already for them. So I think that will be a very big driver for this kind of innovation to happen, and also for these products that institutions already access in between them today, for those to also become accessible to retail investors, or effectively from $1 or less.
Thank you, Tycho. And Lior and Andre, as we come to close here, Tycho gave his big, bold 2026 prediction. Would love to hear your view looking ahead to 2026, and what developments or big milestones you think will help to accelerate the adoption of dual staking and stacking. Lior, let's start with you.
Yeah, I think I'm just excited to see more institutions actually come on chain, in various capacities, whether it's through Bitcoin and dual stacking, whether it's through yield vaults, maybe stablecoin yield. I think that there's a huge universe of opportunities that, us as like crypto natives, we've been aware of for quite a few years now. But there's clearly a large learning curve that institutional investors and asset managers are just starting to get over right now. Kind of touching on the point I made previously, like I feel like 2025 was like a big test case for them to start learning about the universe of possibilities beyond just Bitcoin, ETH, and now, you have all these other opportunities to earn yield and essentially, profit from the industry. And 2026, yeah, I think we're going to see more pilot use cases. We're going to see, obviously, we have a lot more regulatory acceptance of the space. So I just think it takes time for these institutions to get involved. And I would expect that we'll see a lot of big headlines in 2026 of things actually moving forward.
Great close. Andre, close us out with your prediction.
Yeah, my big prediction for 2026 is that it will be the year of crypto UX. It's the year that UX and crypto finally gets up leveled, gets a makeover. I think we're going to see the rise of more crypto super apps that really try to abstract away a lot of the complexity of how the protocols work, just to provide a seamless user experience. I think 2026 is the year where we're building products not just for crypto natives, but for mainstream users, and trying to make the onboarding flow as easy as possible. That's what we've done with dual stacking. We built an app. You can go to app.stacks.co. It'll guide you through the process of getting started, staking your Bitcoin through sBTC, staking STX. We have a calculator where you can start to project your rewards through that, and also start to explore the Stacks DeFi ecosystem. So go and check it out. And yeah, that's my prediction.
Wonderful. Thank you very much, Andre, Lior, Tycho. Appreciate the time today and joining our Bitcoin Capital Markets webinar series in this second edition as well. Looking forward to how each of your respective companies and applications continue to progress into 2026, and looking forward to coming back here year to date as well to celebrate the second anniversary of sBTC dual stacking, but then also to have the same conversation again, looking ahead 1 year from now. Tycho, Lior, Andre, have a great day. And with that, everyone, we're going to continue on today's discussion and look towards the next big topic: wallets and custody for productive Bitcoin, following on the heels of what we just discussed in today's panel, and look at how institutions can stay in the world of self-sovereignty. Ladies and gentlemen, please welcome up our next panel. And Brandon, the floor is yours.
All right. Thank you, Kyle. Hello, everybody. My name is Brandon. I am the community growth manager at Stacks Labs. Super excited today to be talking to the two leads behind two of the leading wallets in the Stacks ecosystem, Ken and Will. Ken, going to throw it to you first. Do you mind introducing yourself and just tell us a little bit about Xverse?
Sure, yeah, thanks so much. So I'm Ken, I'm the founder of Xverse. We are essentially building a home for Bitcoin Fi. We have a Bitcoin wallet that supports, a series of Bitcoin L2s, including Stacks. We were one of the first, wallets for Stacks and supporting Bitcoin Web3. And now we are just, building out that vision, and hopefully in the next year or so, we can, really bring that vision to life.
Great. Thanks, Ken. And Will, we're going to throw it back to you. Can you tell us a little about yourself and a little history of Leather?
Yeah, so I was at Kraken for 8 years and joined Leather as an engineering manager. Mark was the GM, and he stepped down and took on some other opportunities, and so I stepped up as the GM. Maybe kind of atypical GM in the sense that I'm really more of an engineer kind of product person, but was excited to step into the role. And it's a small, intimate team. So used to be, at Hero Wallet, and so Leather's been around for a while. And yeah, Leather's a self-custody Bitcoin Stacks wallet for connecting to the Bitcoin Stacks ecosystem. So we support and advocate for all the SIPs and support all the, protocols in the ecosystem.
Great. Will, I'm gonna keep it with you with our first question from a product and engineering perspective. Since you're so close to that level, what design decisions matter most when building a Bitcoin wallet that can safely support more advanced functionality, like you talked about, like that you find on something like Bitcoin DeFi that you get on Stacks? What is most important there?
I think we, as a team, really value, and like our engineering lead in particular, has really given us the value of sticking to the protocol, the Bitcoin and Stacks specs, advocating for SIPs, and like getting the community on board before large changes are made to those types of things. So anytime we like deviate from them, or there's another tool or whatever that has slightly deviated from, say like derivation addresses or whatever, it uses a different index or something like that, it causes a lot of downstream headaches. So I think for us, we really value sticking closely to the specs and the protocols as much as we can, getting community involvement and agreement. And in terms of like the more consumer facing product itself and the code base, we really value building the right abstractions and enabling ourselves to kind of build, not build multiple times for different platforms. And Leather's kind of expanded its offering from an extension to like a mobile app, and we're trying to build out more of a web app feature set. And so trying to consolidate where we build that as a small team is really important to us. And I think, yeah, in a really broad sense, designing and building for simplicity and avoiding complexity wherever possible helps us try to keep the quality bar high. It allows us to be able to test the code and ensure things are running smoothly. And, I think that's always somewhat at odds with new features, new things coming into the ecosystem. So we're kind of constantly doing this little juggling act. Like, do we want to support this? Because, if we support this, that complicates how we handle UTXOs and managing those. And people might accidentally be able to send something they don't want to send, or, and then you have to kind of go through this rabbit hole of now, how do we manage that? How do we enable people to manage their own UTXOs. You know, maybe that's not a thing, that's a downstream effect we didn't anticipate or want to go spend a month on, you know. So yeah, those can have really difficult knock-on effects if you build things that are too complex or compete for resources.
Totally. I'm glad that you mentioned abstraction. I feel like that's going to be a main theme for our talk here.
Yeah.
Ken, I'd love to hear from you about the differences in feedback that you hear between maybe your power users and the institutional users that you work with, and what are the things that institutional users maybe care about more than kind of your average power user or retail user?
Yeah, so at the end of the day, everybody needs a secure wallet, and that's the most important thing. I think the main difference between the retail power users versus an institution is that for institutions they have lower tolerance for a single point of failure, right? They require more redundancy, and there's usually a requirement for more complex approval structures, right? So uh, sometimes with institutions, it's not like one person can make an action to perform something on the chain, right? It usually requires maybe sign off from this person and then that person, um, and I think with Bitcoin that is a little bit difficult right now because Bitcoin itself does not have the primitives in place. There's no smart contracts that are powerful enough to provide this kind of feature, right? There's multi-sig, but that doesn't really satisfy all of these requirements. So I think this is where Bitcoin L2s can come in with smart contracts and more advanced capabilities that can really service institutions.
Great. And thanks, Ken. And Will, as more wallets expand to support L2s like stacks, smart contracts, more Bitcoin primitives, like you talked about, you already kind of touched on it a little bit, but what are some of the hardest engineering or user experience trade-offs that wallets have to make when designing for those things?
One that came to mind for this right away is kind of snappy UX and optimizing for like a speedy user experience. So for instance, you like with Bitcoin, you can have many different derivation paths and indexes for your account. And so looking those things up, it can be a very expensive operation. And for our mobile app, one of the kind of core things we built for that was like multi-wallet support. And at first we just wanted to show everything. It was like, we have all these wallets and we support multiple wallets, multiple accounts. So let's show all the data, but that is quite expensive and it comes at a cost. It's very slow to do. So looking up all the account activity, all the balances, all these things. So that's a trade-off of like comprehensive coverage of what we're showing a user versus the speed at which we can show it. And so we scaled that back. We're like, let's just focus on what we're showing so that people can get, the information they want quickly and not have to wait for that thing to load. And I think same thing with something like smart contracts. Like there's different levels of assumptions about what people want to see in terms of the comprehension of that information. Like developers who are using our wallet want to see a lot. They want to be able to go read through and all the details. A more consumer oriented person they just want to know, is this safe, is this secure, and to continue on with their end goal, which is not to review a contract. It's to accomplish some other task and put funds in another protocol or something like that. So I feel like we do a lot of back and forth discussion about how much should we show here, how much should we reveal initially or immediately, and how much should be a choice to reveal, like an expanded row or an alternative screen or a sheet to show something, a modal to show information. So we do a lot of back and forth kind of debating between what to show, how much, and in what contexts. Yeah, and I think again, as a small team, we're kind of constantly like asking ourselves, does this make sense for us to support, for different protocols or things like, ordinals, runes, whatever. We're like, at what level should we support this? Because it's not free to support this thing. It takes time and resources and energy. So I think we do a lot of that discussion and try to strike a good balance between what users are looking for and what we can reasonably support over the long term at a high level, because that's what we want to do in the end is, yeah, support the users and what they want to do with few trade-offs as we can make and high level of, yeah, security and fidelity.
100%. So yeah, so UX super important. I want to ask a few questions on the kind of self-sovereign side. I'd love to hear from both of you on this. And Ken, we can start with you. What would you say is the biggest blocker today for staying self-sovereign for institutions while still participating in DeFi and yield opportunities and all the BTC Fi things that are going on these days?
Yeah, I think one thing that from based on what I've heard is that some of these institutions have uh, restrictions from doing things on chain, and you know, if they cannot do that, then they'll have to go through some sort of custody provider, right? Whether it's a centralized exchange or somebody else. And I feel like that's more on the regulatory, legal side of things, which is, just the requirement. And a lot of that comes from um, being a bit more conservative about crypto, right? They're not able to understand really what happens on chain, and they're kind of scared that something bad might happen that you know you might not be able to take legal responsibilities for, or there's no recourse essentially, right? If you have somebody to hold accountable, or a company or entity, then you have legal means to enforce contracts and things like that. But if things are completely on chain, there's usually no way to like get your funds back if you accidentally perform some action that caused the funds to be sent away, right? So I think there needs to be some work on that end, at least on the on-chain side, to make sure that um, you know institutions can feel comfortable coming on chain and have reasonable levels of recourse if something bad were to happen.
Great. And yeah, Will, same question for you. What would you say is kind of the biggest blocker for institutions to participate in Bitcoin DeFi?
Yeah, I mean, Ken's probably more of an expert there than me. Leather's kind of more consumer oriented in general, but my intuition says that they probably have similar challenges that people do, which is you're kind of handing over, and really this is what Ken said. You're handing over a lot of trust to a protocol that you don't know about. It seems very idiosyncratic. You're just signing some contract that is an algorithm and trusting that that thing runs the way that you think it runs. And one thing that we've noticed too, that I've noticed as a user of the DeFi ecosystem, is your funds can become spread to the wind. It feels like you've got a wallet, a hot wallet, you've interacted with some protocol, you've put funds in there, you have some active position, whatever. But it's hard unless you're keeping track somewhere. It is decentralized in the sense that you have no one place to look to say, where's that money? Where am I stacking? Where am I lending? What protocols have I interacted with? So that's one thing we've been looking at closely, is like aggregating that information. So if you have a wallet that you've used to interact with all this stuff, you can go see, where's that money? What did I do with that? What protocol is that locked in, and for how long? I think that's a real challenge today in the ecosystem.
Awesome. Ken, I actually going to have you expand on what you were just talking about. What role would you say that things like multi-sig and hardware wallets and MPC and hybrid custody models are playing in enabling more productive Bitcoin without sacrificing that control over your Bitcoin?
Yeah, so something like MPC is probably the only way to give you the kind of experience that I explained earlier with advanced approvals on top of Bitcoin, just because there's no smart contracts for you to do that. But I hope, one day we'll have a good experience on a Bitcoin L2 that enables that, and at the same time, fully trustless Bitcoin that can be moved to L2 to do these things. I think, it's we need a combination of all these tools to really build the full experience that caters to whatever the uh, that user's needs are, right? Because everybody's needs are going to be a little bit different. They have different levels of requirements for security, risk tolerance, and things like that. So yeah.
Great. And Will, going a little bit more back to the UX, what does, in your opinion, a good product experience look like when maybe moving BTC from cold storage, from going from hodling to actually making it a productive asset and moving it into Bitcoin DeFi and more productive means? What does that user experience look like ideally?
Yeah, I actually hadn't thought deeply about this until this question was posed to me for this panel. I mean, it's something that we know people do, and the de facto is you just send, or you either connect your like ledger to Lether, or you send from your hot wallet to your, or your rather your cold storage to your hot wallet. Um, but we have talked a little bit about this, just kind of it's just come up cursorily in discussions, and we've talked about ideas where like maybe there's some kind of contracts or smart contracts that you execute for your own account that are like topping up one or the other. So you're like, I have some tolerance for a balance in my hot wallet, and if I ever go above that, maybe I'm getting paid out yield or dividends from some other protocol, I'll just auto send that to my cold storage or vice versa, so you could maybe automate that, but that itself comes with a lot of complexity. And like I do think sometimes the simple thing is the best thing, which is just you just send it. Then it's fully in your control. Um, but it's something that, yeah, having seen this question, I'm like, yeah, we should think deeper about that, because I'm not sure that we have gone super deep there. And it's an interesting use case and something people do every day, in these protocols. And I would never recommend someone go just put all of their BTC in a hot wallet and deploy all of that to some protocol. I think you need to sort of balance the weight of your investments and, have some balance there. So yeah, it's a cool question, and one that I think I don't have a great answer for, and more like, yeah, that's something we should go sit and talk about in a room together. Because it's a use case that's one of the most common, probably.
Yeah. Yeah. I mean, I can say that I personally, moving stuff back and forth all the time. So yeah, super interesting. We're getting a little closer to our time. I have a few rapid fire questions that I wanted to get answers from the both of you on. How would you say, Will, we can start with you. How would you say that users, especially kind of more advanced or institutional users, are balancing that security with that usability? And are there any pitfalls where maybe on your end, like things get over engineered, or maybe risk is not properly managed? Or how would you say that balance between security and usability and UX is designed on your end?
Yeah, again, I don't feel like an expert on this one. It's hard for me to speak to with a ton of authority. But I would say, I imagine if you have good practices, you're using a multi-sig wallet of some kind. So inherently, I think you gain security through friction, like long, complex passwords, moving things to a multi-sig environment where there isn't a single point of failure, but then you have to coordinate the, sends and deployments of these assets. But I think I would imagine if I'm an institution, this ecosystem feels like there's a lot of growing that needs to happen for me to fully go into it and trust it with a lot of money, because I think it's a maturing ecosystem, but it's not mature, if I'm dealing with a ton of money and I have a fiduciary responsibility to my organization, I'm going to dip my toe in maybe, but not go all the way in. So, but again, on Lether, we tend to be kind of more everyday consumer oriented and not so institutional. So I'm very curious what Ken has to say here.
Yeah,
Yeah,
thanks, Will. Ken, go ahead.
So I think maybe one area of security that is perhaps sometimes overlooked is the human, right? I think the human is essentially the weakest link in the security. We see a lot of exploits due to just social engineering. Um, and you need to come up with processes or training for the people that are ultimately in control of whatever security system that you build. And for a lot of institutions, the people that are in control don't necessarily have the level of knowledge to be able to safely hold and secure the funds. So I think there's a lot of work that people need to do to educate themselves, the organization, the people that are ultimately in control, um, regardless of all the other security systems that you set up.
Great. And we're going to rapid fire these last two. Ken, I'll stay with you. Looking ahead into 2026, what improvements or standards do you expect will shape Bitcoin wallet and custody for users?
I would say like smart accounts, which is something that exists on Ethereum and other chains, and it would really bring a lot of new functionality and flexibility to Bitcoin, and I hope to see that happen in the next year.
Great. Will?
Yeah, I've seen a lot of discussion and appetite for this idea of like an embedded wallet in a dApp somewhere, where you're not having to necessarily connect to a specific wallet. And I also think we've kind of had discussions about like a headless wallet, or wallets that run on the server essentially and can allow other pieces of software to interact with them. I think like AI systems are just becoming a norm, and people are starting to use human language to interact with machines much more. So an idea of some kind of like a MCP oriented server architectural wallet where you're like, just tell your whatever favorite tool of AI tool to send this thing, and it'll ask for a confirmation or whatever. So maybe yeah, I don't know if this is going to hold true in the future or not, but I see a possibility of just interacting with text, a lot more like send 5 BTC here to this thing. And it's like, great. And it'll just run that somewhere on a secure server somewhere. I don't know if that's totally a good thing, but I feel like it's probably happening.
Great. And one final takeaway for the both of you. What is one piece of advice maybe that you have for teams that are looking to retain their self-custody while making their BTC more productive? Ken, we'll start with you.
Yeah, I think that's basically have to look at the Bitcoin L2s. That's where the opportunities are going to be.
Love it. Will?
Yeah, probably same answer. Things like sBTC, BTC pegs on L2s to, yeah, do what you will with your Bitcoin, I think.
Awesome. Well, I think that wraps up our time and our panel. Ken and Will, thank you guys so much for joining. For the audience, if you're looking to learn more, you can follow Xverse at Xverse and Leather at LeatherBTC on X. And thank you for joining us.
Thanks, Brandon.
Yeah.
All right. Hello, everyone. Thank you for joining our fireside chat today with Blockdaemon. I'll do a quick intro on my end. I'm Kate Parkman from Stacks Labs. I work on content across the Stacks ecosystem with builders and institutions. Stefan, welcome back. You had joined us earlier this week for our institutional series here, but for anyone joining for the first time, can you briefly introduce yourself, your role at Blockdaemon, and maybe the types of institutional clients you guys work with over there?
Yeah. Hey everybody. Thanks, Kate. Pleasure meeting you. Thanks for having me back. I'm Stefan, Protocol Partnerships Manager at Blockdaemon. We work with 400 plus institutional clients. Think on the more TradFi side, asset managers, family offices, banks, corporate treasuries, and then also on the crypto side, or like somewhere in between exchanges, custodians, wallets. I would say collectively these, manage hundreds of billions of assets, touching our infrastructure in one way or another. And so I'll be speaking from that lens. And I think, we'll probably go into quite a bit just to set the scene. I think what's really interesting is a lot of these companies view things from a very much traditional finance infrastructure viewpoint or standards. And so when they're looking at Bitcoin yield strategies, I think this is new for them. Sometimes there are some misconceptions or, just like knowledge gaps. And yeah, so, it's important to get partners that can help bridge both sides, which, one of this is us. And I'm sure, you guys are the other half to make that happen.
Awesome. Well, before we get into like any type of specific yield strategies, I kind of want to start at the basics because for most institutions, moving Bitcoin in and out of cold storage is a big step and can be scary. So from what you see, what do institutional teams expect from an infrastructure provider for them to feel comfortable and willing to make the move and move their Bitcoin out of cold storage?
Yeah. So maybe just to give everyone a quick background on what we do, right? We have multiple products. Actually, we're not just doing staking. We have a MPC wallet stack that is deployed on-prem, and wallet or managed custody is always the starting point, as you mentioned, right? This is like the first big hurdle I have to overcome, and then we also run nodes and APIs to power these wallets, validators, and then stuff on top like APIs to automate the flows to make it as seamless as possible. All of which is important, but I think really what most companies initially care about and uh, maybe straightforward is security and security architecture. I think that's the biggest one, and then also compliance and operations. Oh, I talked about the wallets, right? Like I think the standard by now is probably MPC wallets, sometimes air-gapped cold storage solutions, and strong fine-tuned cryptographic controls. Because we have to remember, this is not some person having a ledger in the drawer, um, pressing buttons and sending millions or potentially even billions around, but it has to be a tight, really controlled setup. Um, and yeah, this is non-negotiable. This is like the baseline. And then we come to compliance standards like SOC, ISO, KYC, AML, all the standards. These are also not just nice to haves, but they are also, I think, part of the bottom line package. They need to consider before even, moving into Bitcoin yield strategies. And then I think this is one step closer is operations. This is the last one I'd mention. Of course, they need 24/7 monitoring, maybe geo-redundancy, real-time analytics, dashboards, visibility. It's for institutions, it's always about risk mitigation and resilience first. There may be others, right? Like the ones we are looking at often are asset, right? Like banks, asset managers, oftentimes not investing their own funds, but on behalf of someone. So I think there's just another that makes it even more paramount to ensure everything is secure and resilient. And also, the person that actually is responsible at this company has to rest assured that they don't lose sleep if something goes wrong Sunday at 2 a.m. in the morning, but that the provider they have chosen, uh, you know, has someone available around the clock who can fix things. So not just a ticketing system, but a team that works all around the clock. So yeah, I think this is really the entry point where it comes down to the obvious ones, which are really just like blockchain specific, or for any blockchain project, security and compliance. And then I think depending on what you want to go to, like specific operational questions.
Nice. Yeah. I mean, I imagine you have some interesting stories maybe of things that have happened with different clients and partners, but when these conversations happen with your institutional clients, how much weight do validator ops, uptime guarantees, slashing protections, stuff like that? How much does that factor into an institution really being ready to deploy their Bitcoin?
Again, I would say it's risk mitigation above yields. Obviously, there has to be a good balance, right? Uh, if you have very small yields, maybe even this tiny bit of risk that stays maybe too much. I think that's very specific to each company and decision maker. What we do is we have 99.9% uptime SLAs and geo-redundant infrastructure. What's important to us and also to the companies is we cannot be dependent on a single uh, cloud or bare metal server provider, and also not on a single geolocation. But yeah, need to be able, if something fails, if a provider fails, if a energy outage or whatever happens, we can respond swiftly and operate smoothly. I think this is where it starts, and then you make a good point, when it comes to redundancy and monitoring, incident response and slashing. We've got 24/7 monitoring that covers everything, and that's for us specifically. And there's more to it, but it's machines, networks, and protocol level metrics. And I want to highlight the last one because this is, something that these people may not be used to from their existing tech stack. So in blockchain terms, this is like block height, peers, attestations, and then every chain has their own specific metrics or sometimes a different name for something that is exactly the same. Um, and yeah, I think they need to understand these as well, and what the impact is if one of these doesn't work well. And obviously we monitor them, right, to see, does our machine or data center have issues? Is there something wrong with the like architecture or setup of the validator and such? And then to, I think, the last point you make, the slashing. Of course, every protocol is different here, right? Like how they enforce the rules. One thing I think that's really important to most more institutional clients is not only that you can convince them that you got everything under control and run it responsibly, but that you actually back it up with financial accountability. And so we have, besides the uptime and everything, we also cover slashing fees in the SLAs, because I think here's the thing, right? As said, many of these don't just operate that with their own money, but invest or manage customer funds. Um, Uptime directly impacts the yields. Slashing, even more negatively, not only impacts the yields, but even the underlying asset. And so I think when choosing a validator operator, not only, does this choice affect the person's job that makes this decision or, is responsible, or the whole team, but, ultimately it could be many millions of dollars or, other currency affected, or, thousands of Bitcoin, as well as potentially millions of customers who are trusting these companies with their tokens, and then, ultimately us.
Yeah. Yeah. I mean, I would say from the Stack side, what we're looking for is pretty straightforward. We want providers who take security and operations very seriously, have a proven track record, running this type of infrastructure at scale, and are very transparent about how things work and where the risks are. I think, highlighting the risks is always a super important thing. But maybe let's get into sort of the day-to-day side of things, because, this is where things are either working or they're not, and it's very clear which side that falls on. So how does Blockdaemon approach validator operations at the institutional level? Because it's a very big job, keeping things online, monitoring issues, and then responding when something does go wrong.
Yeah, I think, a lot of that goes back to what I talked about. We have a lot of proprietary monitoring built out ourselves, right, and a lot of tooling when it comes to deployment of validators. Of course, for a protocol like Stacks, I think that's a lot more straightforward because hopefully you only deploy it once, and then you have to have a system for failovers in place. If these alerts shoot, that what's happening and how to respond. I think what's really important, also a question that these companies should look into when choosing a provider is how do you respond to the worst case, right? Like what happens if one of these validators go down? I already alluded, we like to run, failovers in different different data center providers in different geolocations, and obviously have a clear engineering protocol in place, like how this key rotation works, ensuring that we are fast to respond, right? But also, I think again, and this is part of the mantra, I would say. Yields are always important, but I think more important is the security and decreasing risk. And so it's not just about automating a key rotation, for example, for a validator if one goes offline to fail over to another, but also ensure that you won't have a double signing incident an hour later because the first validator comes up again. So yeah, I think that's, feel free to dive deeper if you have a specific question, but I think that's really most part of it. First, we have this whole monitoring stack. We have a stack to deploy and manage nodes, try to do the least possible manually, because if you look across all 60 protocols we support, we probably have, thousands of node instances running that get maintained, spun up and down. And then, yeah, just, proper engineering principles and runbooks, how to respond to the worst cases to be fast, but don't make mistakes.
Is there anything in particular that you think institutions overlook when they're doing their due diligence phase with you? I mean, it can be an operational risk, but you keep referring to it's not necessarily the amount of yield, but it's really the security that underlines that. But yeah, is there anything that comes to mind for you that is constantly overlooked or maybe underestimated?
Yeah, I don't know about overlooked. We have done hundreds of RFPs, not, obviously not all Bitcoin related. And I feel at some point every question has been asked. But I think there's certainly a few topics that people should pay closer attention to. And I would also be really curious to hear, what kind of answers you get after I'm done. As said in the beginning, I think lots of people we work with, they have a strong traditional finance background, but also like a traditional software background, and view things through that lens. And blockchains are very different, right? Like as probably most of us here know. And I think it's really important to understand their viewpoint, and then that blockchains don't follow enterprise software update cycles. They're decentralized networks with decentralized engineering teams and not just a single company maintaining it. And so I think two things that you really have to pay attention to and that may be a little overlooked. One is everything around validator operations, like all the stuff I talked about, just before. One, all the protocol metrics, how do they impact me? Slashing, and then maybe some more network specific questions. How fast can I get liquidity back? If I have a wrap token, like how deep is the liquidity? I think also plan from the end in mind, that you ask yourself, like, not just how do I get in, but also how do I get out, and how fast, and is that compliant or in line with what I want to achieve. Then the other is really protocol governance. I think this is a huge one because, as said, right, like blockchains are not traditional cloud infrastructure that follows a clear schedule, hopefully most of the time. But you get, sometimes a surprise hard fork, emergency upgrades, depending on the chain, happen quite a bit. Governance votes that need immediate action, and that are something I want to say that are completely novel to the traditional enterprise world. And we as Blockdaemon, we work close with foundations and try to maintain really good relationships with core dev teams to know what's coming, and also always looking at that worst case if something happens, if there's an emergency upgrade, if there is a security gap in a protocol, that we can tap into these pools of talent, but also maybe share our opinion and sometimes also be part of resolving issues. And I think this is just, what's really fundamentally different from how their typical software stack looks like. And I also think they not only need to look into it, but I think they probably also should have people, that not only talk to us, but, people like you, Kate, at the labs teams, at the foundation teams, that can help them answer some of these questions and also, be a good contact point in case there is some sort of emergency.
Mm-hmm. Well, I'll keep it pretty high level, but I mean, I would say from our side, I would say security is the starting point. So, we're looking for partners who kind of assume things will break at some point and have systems in place that can kind of mitigate how far that reaches. So, we want to make sure we can protect funds and recover cleanly as quickly as possible if that's the case. And I think that really just comes down to partnering with people who have operated through, many cycles, real conditions, and not just in theory, but very much in practice. And then everything we do at Stacks is really aligned with Bitcoin's security model. So I think that means really minimizing trust, avoiding unnecessary third parties, and not just taking shortcuts to boost yield. And I think that's what we're really building for. And we can talk a little bit about dual stacking a little bit later. But many conversations that I have with people in Stacks, it's all about building long-term partners. So are you designing systems that are more decentralized, more trust minimized over time? We don't want to lock ourselves into anything that's very fragile and based on fragile assumptions. So yeah, I would say everything that we do is really based around this security mindset, very in tune with the values of Bitcoin, and just making things as transparent as possible, and so that everyone involved can understand the risks as much as possible. Yeah, but I guess we can kind of go in the direction of earning yield on Bitcoin. Obviously, I think there's a huge growing interest in earning yield on Bitcoin. It's definitely where things are headed. But I think there's also a much higher bar for safety and clarity than we've seen in past cycles. And that's obviously, I think we'd both agree, for the better. So I'll throw it back to you. I would say, I'm going to ask you, like, from an infrastructure standpoint, what do you think needs to be in place for these kinds of security first Bitcoin yield models in order to scale in a responsible way?
Is that more focused, I guess, on the Bitcoin model itself, for example, stacks and dual stacking, or also from the, our perspective as an infrastructure provider? Would you say both?
Sorry, can you repeat that? You kind of cut out a little bit
No
on my
worries.
end.
No worries. Like, so I think for companies, there needs to be two things. One is, and I don't want to repeat all of this. This is what I've talked about before, right? What we do at Blockdaemon. So they need, and not only us, but also many others to work together to have the, I guess, accessibility layer to the yield opportunity, to stacks and dual stacking, for example. And that comes down to, again, security, compliance, operations, so that they can operate a professional, secure, compliant, resilient infrastructure from day one. And then I think when you look at the protocol solution itself, right? Obviously there's you and there's some others that tackle things differently. There are also many questions they ask themselves, and also us ultimately. Do I give up control over my Bitcoin? Is it wrapped? And if it is, am I comfortable with wrapping and bridging? And how does that actually work? And, smart contract audits, and where do I draw the line when it comes to risk? Then also what I mentioned prior, right? Like having the end in mind, like how can I get out? What does the process look like? Are there basically any systematic risks, right? For example, for Ethereum, for quite a while, and that doesn't exist anymore, but for quite a while, you needed the validator key to exit your staking position. And if the validator key is only with a staking operator, for example, us, right? Then suddenly you have to trust a third party that they will trigger you exiting when you want to exit. And then I guess you can still say that, in this case, Ethereum would come back to your wallet, So there's an argument to be made that you are still in full control of your Ethereum, but not really of the action, um, the unstaking process. And so I think uh, this is really important to understand. And there's a lot more questions. What happens if the chain gets stalled? Who are like the key players? Besides maybe your infrastructure providers in the ecosystem that you should know, having ties to the foundation, all of that. And then I think only after, having answered all of these questions, from our experience, are you diving deeper into yields? And, then of course you'll have questions around the sustainability of yields. Where do they actually come from? I see a big number now. How does that number, like what makes it happen? How can someone offer 5% when someone else has 1.5? Uh, will that 5% still be there in a year from now or not? I think understanding these mechanics then also becomes really important. And ultimately, that has other implications, that follow up. For example, do I do I say like in full control of my Bitcoin? And if I do, or not depending on the setup, do I need a second asset to stake? If yes, like in which ratio? Where do I get it from? And then also, how do I get my stake and rewards paid out? Or what means stake and rewards? There's no, stake and rewards, quote unquote. My Bitcoin yields. How do I earn them? Is this in Bitcoin? Is it native Bitcoin, or is it some sort of wrapped Bitcoin? Is it some other currency? Is it maybe a basket of currencies, right? And that again has a lot of ripple effects. Obviously one that comes to mind is what Babylon was doing, or like the whole idea behind it initially, having securing many chains and then getting paid in these rewards. Many companies we talked to, they wanted to earn yields on their Bitcoin in Bitcoin or in stablecoin, not in many other currencies. And then, the question comes up, does my custodian even support all these other currencies? How do I get them back into Bitcoin? Do I have to look deeper into AML? I know I'm already, I'm going in a big rant here, but I think
That's
there's
good.
many questions. But ultimately, if to close this, ultimately, I think existing and new Bitcoin, yield offerings have to look at that from a enterprise and company perspective as well. You don't need to serve everyone, right? Like everyone has their market, understand that market well, and ensure, yeah, that they have these institutional frameworks in mind when creating or maybe changing their systems. And yeah, I'll stop here and would also be really curious to hear what you think and how you guys think about this.
Yeah, I mean, I think that we definitely take the approach of people definitely want to earn yield in Bitcoin on their Bitcoin. So that's like one thing when we were developing dual stacking that's super important and unique to Stacks is, our consensus mechanism transfers Bitcoin to the network participants. And so that factors into the product that we launched called dual stacking. So, people don't really want tokens and points. They want real hard Bitcoin. And we're offering like as close to that as we think is possible. So, you know, where am I going with this? I mean, yeah, so the idea is really like we want to make Bitcoin productive, but keep things like simple and transparent. So I might actually throw it back to you. Like, how do providers like Blockdaemon support setups like this, where Bitcoin stays secure while also being put to work, like I've just talked a little bit about with dual stacking. And if you need me to clarify anything on dual stacking, please let me know.
Yeah, maybe I'll leave the dual stacking explanation to yourself. I think what we do, right? The idea is pretty straightforward. We want to enable customers to keep control of their assets, to keep control of their Bitcoin while we manage the whole infrastructure layer. It doesn't need to be the whole layer, right? Like our stack is compatible with all sorts of wallets, but this is obviously the given, right? We've talked about this. This is the starting point. They need to have a wallet or custodial solution that at least enables them to interact and participate, for example, in dual stacking, and then not only hold Bitcoin but also stacks and do these interactions that are required. How that looks for us, right? if you start your journey full block daemon, you'll have the wallet, and then it connects to our API stack and underlying nodes and validators. And you know, it's all about making it as easy as possible. I think we've come to the conclusion already earlier that making the decision, or you know, getting the confidence that, for example, you know, you can opt into dual stacking and actually make your Bitcoins work is not an easy decision. And so once people are there, we want to keep it simple for them. We don't want them to run their own infrastructure. We don't want them, you know, to run their stacks validators and monitor Bitcoin and stacks and network health and all of that. We basically abstract that away, allowing API connections to have it as easy to manage and maintain as possible. And optimally, right, this is plugged into, or, you know, they are plugging in from a custody and or wallet solution that also has this whole security in mind, that they have, you know, strong policies to ensure nobody unauthorized can control the Bitcoins or change anything about the positions. But yeah, they have the security set up, and then they have as seamless as possible integrations through APIs to participate.
Mm-hmm. So I think, but Bitcoin definitely has a much higher bar when it comes to security and trust. You know, you've talked about you guys support different networks. From your perspective, is there any major differences that makes supporting Bitcoin-based yield fundamentally different or much more trustworthy than supporting other networks?
Yeah, I think, you know, I think it takes not necessarily some belief. I think Bitcoin itself has a very secure setup in itself, right? How you control and manage your Bitcoin may be actually more attractive to institutions than some other chains. That's for sure. That being said, I think where they have a little bit of an issue when it comes to Bitcoin yields is that, and this, you know, taking a step back, this very much depends on the, I guess, expertise that this company already has when they interact with anything DeFi, right? Most of the companies we work with, they don't just hold Bitcoin, they have several assets and may already be really familiar with Ethereum staking and know what this looks like. And, you know, many staking networks follow more or less the same principles. And now I think this is where Bitcoin is really different, right? Because Bitcoin does not have this native on Bitcoin yield, but you will need a solution like Stacks, for example. And I think here it just needs, you know, guidance and good education to help decision makers and, you know, the tech people understand how this is different from your typical staking setup, how it can work, how you can actually earn yields on Bitcoin. And then, you know, I think again, firstly, you'll address everything around all security concerns to make people feel at ease, and then second, tackle how the yields actually work, right? How you can maybe boost them and not. And, you know, obviously, Kate, this is when we're talking about Bitcoin yields on chain, which I think this whole thing is about, right? What we obviously have seen a lot is also Bitcoin borrowing and lending, where we not really have a stake in, you know, very much, I think, a TradFi thing working with crypto. What we're really eager to see and support is on-chain yield earning possibilities for all these Bitcoin that lie dormant in treasuries.
Yeah, I totally agree. And again, I'll just keep beating this drum, but I think doing that in the most transparently way possible, and really like highlighting risks up front is super important. Well, we're at the end of our chat. That was really amazing. Stefan, you very eloquently put all of this. So thank you so much for, you know, walking us through the real world side of this. If there's anything last you want to say, please do. But thank you so much for joining me here today.
Yeah, thank you, Kate. Thank you, Stacks, for having me and having Blockdaemon. And I can just mirror what you said. Really excited working with you guys. And we also appreciate all that you highlight. Uh, keep talking about transparency, about putting risk first. This is exactly how we approach it as well. And I think I'll just end it with this again. We often or mostly viewed from the perspective, and this is the perspective of the companies we work with. They look at risk and risk mitigation first, and then yields. They often manage, the tokens of someone else, not your own. I think it's a very different story when you, as a private person, want to earn yields. But yeah, this is how we approach it, and this is also, how we work together with you guys.
Amazing. Well, thank you so much, Stefan.
Thank you.
Thank you very much, Kate and Stefan, and also Brandon on our second panel as well. And to all of our panel guests today, and each and every one of you for tuning in to part 2 of the Bitcoin Capital Markets virtual series. Our first part earlier this week was talking about the institutional shift. As again, we're looking at how Bitcoin is evolving as a store of value asset into a productive asset class, and what that future looks like, whether it be from the operational frameworks and custodian frameworks that we talked about earlier this week, to what we discussed today around dual stacking and staking along with self-custodial sBTC, but also Bitcoin as well, and what that means when you hold your Bitcoin as well. We talked a lot today about the wallet in custody side of productive Bitcoin. And as Kate and Stefan just close us out with the yield strategies for productive treasuries. We also discussed a little bit about what's happening in capital markets and financial products on a global level, as over 2.5 million, or about 12% of Bitcoin's total supply, sits today idle in financial products throughout capital markets, and what happens when that begins to wake up and move. A big thank you again for everyone tuning in, and to all of our moderators and panelists. Everything discussed today was for educational purposes only and not financial advice. Please take the time to do your own research. Now, we will see you back here in early January for part 3 of our Bitcoin Capital Market series to talk deeper about those yield strategies and productive treasuries as well. And most importantly, we will be kicking off tomorrow with our annual Stackies Award ceremony to celebrate all that has happened throughout the entire Stacks ecosystem and the developments that have kicked off in the ecosystem side of Bitcoin as well. That said, everybody, I'm your host, Kyle Ellicott. Have a wonderful day, and we'll see you back here soon. Take care.